Douglas Isles, you're an investment specialist with Platinum. It feels from an investor perspective that we've lived through a period of prolonged doom and gloom, but I know there's a few things that you're fired up about and really excited about, and what are those?
Well, firstly, Catherine, I can correct you a little bit. We've actually gone through a period of pretty incredible investment returns. I mean, we've done 17% a year for the last 4 years, which is well above our long-term average. So we do have to keep the doom and gloom into perspective. I think the last year has probably been more disappointing for people, but keep that 4 years into perspective. That's a very, very good return. But what's really exciting us today, and it's one thing, it's change. People fear change. All financial theories tell you that when there's uncertainty, you should seek a higher return, which is basically paying a lower price. So people do not pay for uncertainty. And what we try and do at Platinum is we try and understand uncertainty, try and work out what's really going on, and that's where the best opportunities lie. So there's been an incredible crowding into what would be called the safety trade in the last few years. People have wanted to buy REITs, utilities, consumer staples, predictables. And we're really, I mean, I look at it almost like the tech boom. Everyone wanted to own tech and nothing to do with the old economy. Today, everyone wants to own safety and nothing to do with uncertainty. So we have a portfolio that's jam-packed with cyclicals, technology, disruption, Asia Pacific. We've got a lot of exposures to China, India, Korea, Japan, banks in Europe, and we can find some great stuff that's on incredible value because of the crowding in markets. So I think it's that fear of change which is creating opportunity at this point in time. And I think the most important thing in that regard is since the end of June, the world has changed. So we had Brexit, we've got a sense that inequality is not working. So rather than worrying about inequality, we're already seeing a change. We're seeing low incomes go up in the US. We're seeing a discussion about fiscal spending. That's good for cyclical assets. And the other change we're seeing, which gets missed by a lot of people because they're focusing on the US primarily, China is recovering, it's re-accelerating. And China growing at 5 to 6% a year is fantastic for the Asia Pacific region. So these things excite us.
Yeah, one of the reasons that, investors are happy to pay you a premium relative to index management is because you manage money completely differently to the index.
Yes.
So one of the things that's marked about your portfolio is how differently you're dispersed geographically to the index but to other managers.
Yeah.
Why is that important?
Well, we look at other managers and look, here in Australia, there's lots of people trying to offer you global products. We would question the word global in a lot of the products. The US makes up about 36% of world market cap, the opportunity set. We do not know of an established manager with less than 40% in the US. So every single...
Other than you?
Other than ourselves. We have 7, just to put it into perspective.
So you have 7%?
7% in the US.
Right.
The US is about 15% of world economic activity. The stocks are about twice the price of the rest of the world. It's a market that's priced at a level that has never historically delivered you a return. So the only time the US market's been more expensive than this was during the tech boom, and the only time it's been similarly valued was just before the GFC and just before the crash of 1929. So it doesn't make sense to us to allocate a lot of people's capital. It's not our money. It's our clients' money. So most fund managers are putting half their clients' money or even more in a market that's overvalued, overrepresented, and the opportunities as we see them and the growth is primarily in the rest of the world. So we've got half the portfolio in Asia. That's where the growth is. Most managers seem to avoid China, avoid India. A quarter of the world's population lives there. It's developing. There's reform taking place. There's a recovery in China. There's growth in India. We think it's crazy.
And notwithstanding a 17% per annum return over the last few years,
yeah,
the under exposure to the US has hurt your performance relative to others.
Yeah.
Would your argument be that because you're positioned so differently, you're best placed to outperform if we see the sort of change that you're talking about?
I think so. I mean, we're talking very short term here. We're talking 4 months, but since the end of June, our fund's up 6%, the market's up 1%. Something has changed in the world, so that it's being driven now by a backing away from safety. It's very difficult to categorically say that there has been a change, but we're observing definitely different behaviour in markets. So since the end of June, we've had consumer staples, healthcare, utilities, telco shares, they're all falling. People are starting to think, well, maybe there's value elsewhere, and that's how we're positioned already. So we would expect to do well in that kind of environment. And if the crowd leaves the US and looks for somewhere else to put their money, then we're already there. They can buy from us.
Well, it's great to see an active manager fired up. So looking forward to some outperformance and some interesting times.
Thanks very much.